Ever wondered what stock option derivatives are? Well, let's break it down. The word derivative may sound complex, but it simply refers to a financial instrument whose value is derived from the value of another asset. Picture a mirror reflecting an object. The image you see is dependent on the object, much like how a derivative's value depends on its underlying asset. In the realm of finance, these underlying assets can be various things like commodities, bonds, currencies, and yes, stocks. That's where we get stock derivatives. Now there's a particular type of stock derivative that's quite popular among investors and traders alike: stock option derivatives. They're a bit like your favorite choose-your-own-adventure book. You see, they give the holder the right but not the obligation to buy or sell a stock at a set price within a specific time frame. Intriguing, isn't it? Now that we've established what a derivative is, let's delve into stock option derivatives. Stock options are a type of derivative that gives you the right, but not the obligation, to buy or sell a stock at a predetermined price. Now let's dive a bit deeper into the basics of stock options. Firstly, there are two types of stock options that you need to know about: call options and put options. Both of these options are essentially contracts that give you the right to buy or sell a stock, but they function a bit differently. A call option, for instance, gives the holder the right to buy a certain stock at a predetermined price. This price is often referred to as the strike price. So if you believe that a stock's price is going to rise, you might buy a call option. If the stock price does indeed rise above the strike price before the option's expiration date, you could buy the stock at the lower strike price and then sell it at the current higher price, making a profit. On the other hand, a put option gives the holder the right to sell a stock at a predetermined price. If you believe that a stock's price is going to fall, you might buy a put option. If the stock price does indeed fall below the strike price before the option's expiration date, you could buy the stock at the current lower price, and then sell it at the higher strike price again, making a profit. It's important to note that these options usually have an expiration date. This means that you have to exercise your right to buy or sell the stock before this date. If you don't, the contract becomes worthless. So with these options, you're betting on where you think the stock price will go. It's a way of speculating on a stock's price movement without actually owning the stock. But remember, like all investments, there's always a risk involved. So it's essential to do your research and understand the market thoroughly before diving in. The price of a stock option derivative depends on several factors. Now let's delve into what these factors are and how they influence the pricing of stock option derivatives. Firstly, the price of the underlying asset plays a vital role. The underlying asset is what the option gives its holder the right to buy or sell. Naturally, if the underlying asset's price is high, the option's price is likely to be high too, and vice versa. Secondly, the strike price of the option is a significant factor. The strike price is the cost at which the option holder can buy or sell the underlying asset. If the strike price is low, the option's price is likely to be high, since it's more attractive to be able to buy or sell an asset at a low price. On the flip side, if the strike price is high, the option's price may be lower. Next, the time until expiration is another key element. The longer the time until the option expires, the more valuable it is. This is because there's more time for the underlying asset's price to move in a favorable direction, increasing the likelihood that the option will be profitable. Therefore, options with longer expiration times generally have higher prices. Lastly, the volatility of the underlying asset's price is a crucial factor. Volatility refers to the degree of variation in the price of the underlying asset. Higher volatility increases the potential for profit, as there's a greater chance of the asset's price moving in a favorable direction. Consequently, options on highly volatile assets tend to be more expensive. In addition, there are other minor factors such as interest rates and dividends that can influence the pricing of stock option derivatives. But for the most part, the four factors discussed here are the primary drivers of an option's price. All these factors contribute to what's called the options premium. So, when you're considering buying or selling stock option derivatives, it's crucial to understand these factors and how they impact the options premium. Understanding these can help you make well-informed investment decisions. As with any financial instrument, stock option derivatives come with their own set of benefits and risks. Let's start with the benefits. One of the major advantages of stock option derivatives lies in their potential for high profits. Unlike traditional stock investments, where the profit is directly proportional to the increase in the stock price, option derivatives can yield significant returns even with a minor fluctuation in the stock price. This is because you are essentially betting on the movement of the stock. not the stock itself. In addition, stock option derivatives offer the flexibility to speculate on stock price movements without owning the actual stock. This means you can benefit from a stock's price movement, whether it's going up or down, without the need to buy or sell the stock itself. This flexibility opens up a wide range of strategic possibilities, allowing investors to hedge their investments, generate income, or speculate on market movements. Now, let's discuss the risks. The first and foremost risk is the possibility of losing the entire investment. If the stock price doesn't move in the direction you predicted, your options may expire worthless. This is a stark contrast to investing in stocks directly, where you still own the stock even if the price falls. Moreover, stock option derivatives are complex financial instruments. They require a good understanding of financial markets and the factors that influence stock prices. Without this knowledge, you may end up making poor investment decisions that can lead to substantial losses. Lastly, the pricing of stock option derivatives can be influenced by a variety of factors, including interest rates, dividends, and market volatility. These factors can make the pricing of stock option derivatives unpredictable and increase the risk of loss. So there you have it, a basic understanding of stock option derivatives. Remember, always do your research before diving into any investment. Stock option derivatives can seem complex, but with a bit of knowledge, they can be a valuable tool in your investment strategy. Remember, they offer the right, not the obligation, to buy or sell stocks at a predetermined price. Pricing these derivatives depends on various factors like volatility, time, and intrinsic value. While they can provide potential profit and hedge against risk, it's crucial to understand the inherent risks too. Understanding these financial instruments can open up a world of investment possibilities. Thank you for watching and stay tuned for more financial insights.